Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Ford Motor Company was founded in 1903 by Henry Ford in Detroit. The Model T democratized automobile ownership, and the moving assembly line in 1913 transformed manufacturing practices across virtually every industry on Earth.
Today, Ford runs three distinct business units. Ford Blue handles traditional internal combustion vehicles, Ford Pro serves commercial fleets, and Ford Model E is the loss-absorbing electric vehicle investment division.
The F-Series pickup truck is the cornerstone of the entire enterprise. America's best-selling vehicle for 47 consecutive years, it generates an estimated $60 billion in annual revenue from a single product nameplate.
Ford Pro is the fastest-growing and most profitable segment. It sells trucks, vans, software subscriptions, and financing packages to commercial fleet operators, building recurring service revenue on top of each vehicle sale.
Ford Blue handles the traditional ICE business, combustion engine cars, SUVs, and Broncos that deliver solid operating margins. The trade-off is that ICE faces long-term disruption risk as electrification accelerates globally.
Ford Model E is intentionally absorbing losses. The division invested billions in Mustang Mach-E, F-150 Lightning, and the underlying battery and software infrastructure needed to compete in electric vehicles at scale.
The three-segment reporting structure is a strategic clarity decision. Separating EV losses from ICE profitability lets investors and management see exactly where value is created and where capital is being consumed.
Jim Farley became CEO in 2020 and has driven the three-segment restructuring along with a massive EV investment commitment. His prior experience at Toyota gives him a manufacturing-first operational perspective.
On the competitive radar, Ford sits alongside General Motors, Stellantis, and Toyota. The ICE margins are broadly comparable, but Toyota scores significantly higher on balance sheet resilience and operational efficiency metrics.
The dividend history reflects the cyclicality of auto manufacturing. Ford suspended the payout in 2020 during the pandemic, reinstated a modest dividend in 2021, and has gradually rebuilt it alongside periodic special dividends.
Ford sells vehicles in over 100 countries through more than 10,000 dealerships worldwide. The dealer network is a distribution strength and also a structural constraint as the industry considers direct-to-consumer EV sales models.
The fundamental long-term question is whether F-Series and Ford Pro profitability can fund the EV transition before battery economics and competitive dynamics erode the core ICE earnings base that supports everything else.
Ford Credit manages over $140 billion in vehicle financing, a capital-intensive business that adds interest rate sensitivity to the revenue mix, but also deepens customer relationships across the ownership cycle.
With 174,000 employees and operations spanning dozens of countries, Ford remains one of the most globally interconnected manufacturing enterprises in the world, with supply chains stretching across multiple continents.
That's the company chapter for Ford Motor Company. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Here is a beat that makes you double-check the math. Ford Motor Company reported first quarter 2026 earnings per share of 66 cents. Analysts were expecting 18 cents. That is not a rounding error. That is a 261% beat, one of the largest absolute surprises from a company of this scale that I can recall in recent memory. The stock still trades around $10, the dividend still yields 6%, and Wall Street's consensus is still hold. So what is going on? Is this a company in genuine structural improvement, or a one-quarter wonder propped up by favorable items that won't repeat? The answer has real consequences. Ford is the second largest domestic automaker, a company that moves trillions of dollars of metal and software annually. And if the Pro commercial vehicle unit is genuinely becoming a high-margin franchise, the traditional automotive discount the market applies may be significantly too severe.
Ford Motor Company is one of the most recognizable industrial names on Earth. founded in 1903 and headquartered in Dearborn, Michigan. The company today operates through three distinct reportable segments. Ford Pro covers commercial vehicles, transit vans, F-Series Super Duty trucks, and the fleet software and services business. Ford Blue covers internal combustion engine passenger vehicles and the iconic F-150 pickup. And Ford Model E covers the electric vehicle business, including the Mustang Mach-E and the F-150 Lightning. The market cap sits at approximately $46.6 billion. Ford sells vehicles in more than 100 markets globally, with North America as the dominant profit center. The company employs roughly 170,000 people worldwide and carries one of the most recognizable product lineups in automotive history, anchored by the F-Series, which has been the best-selling vehicle in the United States for over 40 consecutive years.
The Q1 numbers are genuinely striking. Revenue came in at $42,664 million, a massive top-line figure that reflects the scale of Ford's global operations. EPS of 66 cents crushed the 18-cent consensus estimate by 48 cents, which is a 261% outperformance. Two drivers dominated the beat. First, Ford Pro delivered exceptional commercial vehicle margins. Fleets are ordering in volume, and the software and telematics business attached to Pro is growing at a rate that has no analog in traditional automotive economics. Second, warranty costs improved meaningfully. Ford has been hemorrhaging money on warranty claims for several years. Quality issues with certain ICE models created an enormous drag on profitability, and Q1 showed genuine, measurable progress on that metric. When a company that has been absorbing chronic warranty losses starts showing improvement, the margin impact can be significant and durable.
Walking through the income statement, Ford's $42.7 billion in revenue represents a meaningful scale advantage that is easy to underestimate. The Ford Pro segment is the standout. Commercial vehicle operating margins in the high single digits, approaching double digits in a strong quarter, are fundamentally different economics than traditional consumer automotive. Fleet customers buy in volume, they pay for service contracts, they subscribe to Ford's Pro Intelligence software platform for telematics and vehicle management, and they repurchase predictably. That creates recurring revenue streams with a profile more similar to software as a service than to traditional new vehicle sales. Ford Blue, the ICE consumer segment, remains a strong free cash flow generator anchored by F-150 demand. The earnings quality concern is Model E. The electric vehicle segment is still generating significant operating losses as Ford invests in battery technology, manufacturing scale, and vehicle development. Those losses are a known quantity, but their trajectory in relation to volume growth is a critical variable for the full-year story.
The Ford Pro deep dive is essential to understanding this company's bull case. Ford Pro is not just selling trucks to fleets. It is building a software and services ecosystem around those vehicles that generates revenue streams with gross margins that look nothing like traditional automotive metal. Pro Intelligence, Ford's fleet management platform, charges subscription fees for telematics, route optimization, maintenance alerts, and driver behavior monitoring. A transit van or a Super Duty truck that runs Ford Pro software is essentially a connected device generating data and subscription revenue for the life of the vehicle. Fleet operators who buy into the ecosystem face meaningful switching costs. As Ford's commercial vehicle install base grows, the software revenue compounds. If Ford Pro is eventually valued on a revenue multiple consistent with commercial fleet software businesses, rather than on automotive earnings multiples, the implied value of the segment alone could approach a significant fraction of Ford's current entire market capitalization. That is the insight the market is beginning to grapple with.
On cash flow and the balance sheet, Ford's financial services arm, Ford Credit, is an important component of the overall financial picture. Ford Credit provides financing to both consumers and dealers and generates meaningful net interest income. The consolidated balance sheet is large and complex, as is typical for integrated automotive and financial services companies. The industrial free cash flow generated primarily by Ford Pro and Ford Blue is the key metric for investors focused on capital returns and reinvestment capacity. Ford has historically targeted positive industrial free cash flow through the cycle, and the Q1 performance reinforces that the core industrial business, ex Model E losses, is generating healthy cash. The company carries substantial debt across both the industrial and financial services segments, which is standard for automotive manufacturers with large captive finance operations. Net leverage at the industrial level is a more meaningful measure and remains manageable given the earnings trajectory of Ford Pro.
Capital returns are a meaningful part of the Ford investment case. The company pays a regular quarterly dividend of 15 cents per share, which at a $10 stock price represents a 6% annualized yield. That is an extraordinary income return for an investor comfortable with the underlying business risk. Ford has periodically supplemented the regular dividend with special dividends in years of strong cash generation. Share buybacks have been less consistent than at some peers, as management has prioritized maintaining balance sheet flexibility during the EV investment cycle. On guidance, Ford typically provides full-year earnings before interest and taxes guidance, and investors will scrutinize whether the Q1 beat leads to an upward revision. If warranty improvement continues as a structural trend rather than a one-quarter event, and if Ford Pro maintains its margin momentum through the seasonally stronger spring and summer selling season, guidance upside is a real possibility.
Management commentary in Q1 emphasized several themes. First, executives expressed confidence that warranty cost improvements reflect genuine engineering and quality process changes rather than one-time accrual adjustments, which is an important distinction for investors trying to assess earnings quality. Second, Ford Pro management described the commercial vehicle backlog as healthy and noted that fleet customers are ordering ahead given vehicle availability and the value proposition of the integrated software platform. Third, on Model E, management reiterated the path toward profitability while acknowledging that the timeline is dependent on battery cost reduction and consumer EV adoption curves. Fourth, tariff risk was addressed directly. Ford has North American manufacturing scale that provides some protection relative to more import-dependent competitors, but exposure on components sourced from Mexico and Canada creates genuine uncertainty in the current trade policy environment. The overall tone was cautiously optimistic, better than expected results delivered with appropriate hedging on the macro and trade policy outlook.
The analyst community is in an interesting position on Ford. The consensus is hold, not buy, despite the massive Q1 beat, and the 12-month price target sits at approximately $10.50, implying only about 5% upside from the current $10 price. The hold consensus reflects genuine structural uncertainty around the EV transition. Analysts acknowledge that Ford Pro is a high-quality business. Most also acknowledge that Ford Blue generates reliable free cash flow. The disagreement is over Model E, the pace of losses, the timeline to break even, and whether Ford can establish a credible competitive position in electric vehicles against Tesla, emerging Chinese competition, and General Motors' Ultium platform. Until there is more clarity on the EV path, many institutional analysts are reluctant to upgrade Ford to buy, despite the improving operational metrics. A string of quarters that demonstrate sustainable warranty improvement and pro margin consistency could change that calculus.
On valuation, Ford trades at approximately $10 per share against a consensus price target of roughly $10.50. At face value, that is an uninspiring implied return. However, the valuation math looks very different if you apply a sum of the parts lens. Ford Pro, generating commercial vehicle margins approaching those of industrial software businesses, is arguably worth a premium multiple on its earnings stream alone. Ford Blue, a stable ICE franchise anchored by F-150, generates free cash flow that supports the dividend at current levels. And Model E is valued at near zero by the market, which is either fair given the losses or an option on a massive EV transition that the market is discounting entirely. A realistic sum-of-the-parts analysis suggests Ford's intrinsic value could be materially above $10 per share if Pro and Blue are valued on appropriate multiples rather than blended automotive earnings multiples that are depressed by the EV drag. The 6% dividend yield provides a meaningful income cushion while investors wait for that value to be recognized.
Bull case number 1. Ford Pro becomes a franchise that commands a software-like valuation premium. If fleet software and telematics revenue continues to grow rapidly, and the economics of connected commercial vehicles support that growth, Ford Pro's revenue mix will shift meaningfully toward recurring, high-margin software streams. As that shift becomes undeniable in the financial results, institutional investors who have historically avoided Ford as a cyclical automotive play may begin to underwrite a higher multiple for the segment. A re-rating of Ford Pro, even to a modest premium relative to pure software companies, would add billions of dollars to Ford's implied equity value. Given that Ford Pro is a market leader in commercial vehicles in North America with growing software attach rates, this is not a speculative scenario. It is a matter of when the market acknowledges the transformation, not whether the transformation is happening.
Bull case number 2 is the warranty improvement story. Ford has been one of the worst performers in the automotive industry on warranty claims for several years, and that has been a significant earnings headwind, at times running into billions of dollars annually. If the Q1 improvement represents the beginning of a structural reversal driven by actual quality gains in engineering and manufacturing, the earnings uplift over the next several years could be substantial. Warranty expense reduction flows directly to the bottom line with no revenue offset required. A company that was absorbing $1 to $2 billion annually in excess warranty costs relative to a normalized baseline, and that begins to close that gap materially, would see earnings power increase in a way that current consensus estimates do not capture. This is a risk-reward asymmetry that favors early identification of the trend, and Q1 2026 may be the first data point in what becomes a multi-year quality improvement narrative.
Bull case number 3 is the dividend and income angle. Ford's 6% dividend yield at current prices is one of the highest among large-cap industrials in the S&P 500. At $10 per share with a 15-cent quarterly dividend, investors are being paid to wait for the EV transition thesis to resolve, for warranty improvements to compound, and for Ford Pro's software revenue to mature. If the dividend is maintained, and Ford Blue's free cash flow supports it comfortably through a normal cycle, the income return alone makes Ford competitive with many fixed-income alternatives. In a market environment where income generation is valued, Ford's dividend yield provides a margin of safety that pure growth stocks cannot offer. An investor who buys Ford at $10 and collects the dividend for 3 years has effectively reduced their cost basis by 18% while waiting for any potential re-rating on the sum of the parts thesis. That is a patient but compelling risk-reward profile.
Bear case number 1 is EV losses with no clear endpoint. Model E has been generating operating losses measured in billions of dollars annually, and despite management guidance about the path to profitability, the timeline remains uncertain. Every dollar lost in Model E is a dollar that cannot be returned to shareholders or reinvested in Ford Pro and Ford Blue. If EV adoption in the United States remains slower than projected, due to charging infrastructure gaps, range anxiety, or consumer preference, Ford's EV volume assumptions may not materialize on the schedule needed to achieve manufacturing scale and cost reduction targets. In that scenario, Model E losses persist longer than modeled, and the capital deployed in EV plants and battery investments generates returns well below the cost of capital. The market is pricing in significant skepticism about EV profitability, but there is a scenario where that skepticism is too optimistic and the losses run deeper and longer than current consensus assumes.
Bear case number 2 is tariff risk and UAW labor cost inflation. Ford has meaningful manufacturing and supply chain exposure to Mexico and Canada, and any escalation in North American trade tensions could significantly inflate component costs. Unlike purely domestic producers, Ford cannot quickly relocate complex manufacturing supply chains. The capital investment and lead times involved are measured in years, not months. Simultaneously, the UAW contract settled in late 2023 included substantial multi-year wage increases that are working through the P&L. Labor cost inflation plus potential tariff cost inflation plus the ongoing Model E investment creates a scenario where operating margins face multiple simultaneous pressures. General Motors and Stellantis face similar headwinds, But competition in the commercial vehicle space from both domestic and international players adds a market share dimension to the cost pressure story. A combination of tariff escalation and slowing fleet demand, however unlikely, could reverse the Q1 momentum faster than the market anticipates.
The verdict on Ford is genuinely nuanced. The Q1 beat is real, the Ford Pro momentum is compelling, and the warranty improvement story is worth taking seriously. Against that, the EV losses, tariff uncertainty, and labor cost inflation create a complex financial picture that explains why the analyst community is parked at hold rather than piling into a buy recommendation. The 6% dividend yield provides meaningful income, while the structural questions resolve, and the sum of the parts math suggests intrinsic value above the current price. But patient capital is required to let that thesis develop. Ford is not a simple stock, but for investors who can hold through the noise of the EV transition, the combination of Ford Pro's emerging software franchise and the income from that dividend is a return profile that deserves more credit than a $10 stock price implies. Financial data sourced from Financial Modeling Prep. Charged alpha is for educational purposes only and does not constitute investment advice. Always consult a qualified financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.